Hi, I'm Linda Eedes. This is an update on the RECM Balanced Fund, looking specifically at the first quarter of this year, talking to some of the changes in the portfolio, the drivers of returns, and then also discussing briefly how the fund is currently positioned. So the first quarter of this year was a very strong one, not only for South African equity markets, but for global equity markets and just about every equity market around the world, both developed economies as well as emerging markets. The South African equity market was up around 8% during the quarter. But if you actually drill down, you will very quickly see that in actual fact it was driven by a very narrow base. If you look at the top 5 stocks of the all-share index, which of course includes Naspers, which was up 19%, and the likes of Richemont, which was up 12%, those 5 stocks actually drive 90% of the 8% return. So it wasn't a broad-based rally that you saw in the local equity market. In fact, many of the South African businesses, the more sort of South Africa incorporated industrial businesses and the like, actually had quite a difficult quarter. Globally though, there was a very strong resurgence in the growth stocks, in particular in technology. The US market was the strongest, but in fact our global portion of this fund doesn't have that much exposure to US, and in fact has no exposure to technology stocks, but that still contributed quite strongly. The fact that we had exposure to markets such as the UK, in fact sterling actually strengthened slightly. Many of the stocks such as Tesco were up considerably, despite the fact that Brexit continues to have a lot of uncertainty surrounding it. Tesco is up over 20%. I think there perhaps is a bit of fatigue with all of the uncertainty around Brexit, and investors are deciding to perhaps take a closer look at those businesses which are trading on interesting multiples. So the offshore exposure did contribute to returns, and the Balanced Fund was up 2.2% for the first quarter. The local side of the portfolio was pretty much flat, as I say, because we have quite a strong exposure to the more sort of locally focused, as I say, nuts and bolts types industrial businesses in South Africa. Although the fund does have exposure to Richemont, which helped it, as well as to some of the resource stocks, in particular Implats, which after a long time of languishing in the doldrums, finally seems to be showing some life and was up actually more than 60% during the first quarter. In fact, over the last 3 years, the fund is up 5.7% per year after fees. And that, I think, reflects sort of the tilt back to value as a style over that time period. If you consider that the average fund in that category, in the Reg 28 category, was up only 3.5% per year over that time frame. So I think what the Balanced Fund takes advantage of is a combination of our size, which allows us to invest further down the spectrum. That's particularly important with regards to the South African opportunity set. Almost half of our exposure on the South African side is to small and mid caps. That is where a lot of the value opportunities sit. And no matter how juicy those opportunities are, the larger asset managers simply are not able to access those opportunities. So that would include things like, for instance, construction company Stefanutti stocks, which is trading on a 3 PE, despite the fact that it is in fact profitable. It includes Avenge, which is trading, we believe, at half of its liquidation value because it's had a huge conversion of debt to equity. So there's this huge overhang of sellers of the stock. Of course, these are all just examples. What we've tended to do is build a portfolio with as many varied ideas as possible, which are hopefully as uncorrelated as possible, such that the portfolio is very robust at the overall level. What you're doing when you're buying value stocks, which are cheap because there is a lot of pessimism around them in the short term, is effectively because of that pessimism, the downside is somewhat protected by the low price you pay. But if things turn out just to be even slightly better than expected, that stock will produce very good returns for the fund and of course for investors. On the global side, we have still, as I say, limited our US exposure. We still have quite a lot of cash sitting on the global side of the portfolio. We did actually take advantage of Rand strength during the quarter to increase our offshore exposure. So it's sitting at about 30%. And rather than that being made up predominantly of US exposure, in fact, the bigger area of our exposure is the UK, along with other emerging markets as well. And we do have some limited exposure to the US, where we see value in good quality businesses such as Berkshire Hathaway or Williams Sonoma and the likes. So contributors, as I say, were stocks such as Implats, Mete was up 17%, Richemont. Detractors were a lot of the local stocks such as Stefanuti Stocks, Hoskin Consolidated Investments, which has a lot of gaming and leisure exposure locally, Avenge, Clientele, Lewis, very strong sort of theme of local and not doing as well as the Rand hedge large caps. During the course of the quarter, we took the opportunity to increase exposure to some of those local names where we see extraordinary value, such as Lewis Stores, which is trading below its net current asset value, which is below its liquidation value, if you look at it that way as a proxy. And we added a few small positions to some deep value situations. So small positions in themselves, but put together represent a fantastic, robust portfolio of undervalued situations. And those included poultry businesses Astral Foods and Quantum Food, and printing company Novus Holdings. So what you have ultimately is a portfolio with very different payoff profiles where the downside is limited and there's substantial upside, which are driven by many diverse sources such that you have a portfolio that is robust, which actually is able to withstand market declines because you're invested in things away from the overvalued parts of the market, but which represents substantial upside in terms of absolute returns from this point forwards.